economist in Fireman's Fund, Federal Reserve Bank of New York, and right now he's Professor of Risk Management and Insurance at Georgia State University. Let's welcome Professor George.
طب عايز
بيجيبوا ليه؟ بيجيبوا ليه؟
دي كله 4 جيجا صح؟
المفروض 4 جيجا و7 5 جيجا.
في عندك اذن
14 15 16 17 18 19 20 كلهم جداد اهو.
عارف انت بتمسكوا البيضه بيبصموا.
لا انا ما مسكتهمش، انا بدهم كده من فوق.
Okay, well, thank you. Sorry for the delay. Let me start by sending a very heartfelt thank you to hosts of the Faculty of Commerce at Harvard University. They've shown me, and I can speak for the rest of the speakers, incredible hospitality during their stay here. Having this done very interesting and engaging, very proud to be part of it. So the theme of the conference is sustainability. I think when you think about sustainability, very often the first things that come to mind are preservation and conservation. So you think about it in industries like fishing or agriculture, for example, for example, sort of making sure that you're taking care of the soil that you can grow in future years, or if you're not, say, overfishing and keeping your stocks at a sustainable level so you can continue on in the future. However, sometimes sustainability requires really transformational change. So, closer to my mouth?
Yeah.
Okay. Sorry, is that better?
Much better.
Okay. Okay. So sometimes sustainability requires thinking about transformational change, not about the business operating in an ecosystem and not disturbing that ecosystem, but rather what happens when the environment changes radically. In those circumstances, business must adopt new technologies, maybe completely change its product or service to meet changing needs or a changing environment. And so what I thought I'd talk to you about today is a case of that in my industry, insurance, and in particular property casualty insurance, which is a business that's in need of constant change, constant evolution in order to survive. So in particular, the industry faced a major existential crisis in 1900, so about 100 years ago, where its main business was basically destroyed, basically disappeared, and it had to reinvent itself. So I'll sort of go through that evolution and share with you how the industry coped with that crisis. And it's currently facing another one, and I'll try to see what lessons we can learn about how the industry might respond to this current crisis in the future. So let's start by looking at the industry in 1900. Property casualty insurance in 1900 in the U.S. It wasn't even called property casualty insurance. It was called fire and marine insurance. Why was it called fire and marine insurance? Well, it was mainly about fire insurance. So about 90% of its business was accounted for by fire insurance premiums. So roughly, this amounted to roughly 1% of GDP. Why fire? There were other kinds of coverages out there, miscellaneous coverages, windstorm coverages. They were still in their relative infancy and still developing. But one of the main reasons was fire was really the major risk to property and to wealth. So back in the 19th century, cities used to burn to the ground. So Chicago in 1871 being a famous example of that. Fire started by, legend has it, by Mrs. O'Leary's cow knocking over a lantern, and the wind was up that night, as it often was in Chicago. Blew across the city, left it in a pile of ashes. New York burned in 1835. The flames were so bright that it could be seen from Philadelphia at night. Boston in 1872. So, not necessarily good for humanity, but good if you were in the insurance industry, or if you were an underwriter. This was a major risk that society was dealing with. When I say fire insurance, I mean it was very, very narrow. If you were an insurance company in 1900, you literally insured against fire and pretty much nothing else. So if we look at the standard policy in 1886, it insures against all direct loss or damage by fire, and excludes a lot of losses, namely, well, if the fire is caused by invasion or riot or something like that, that's not uncommon to exclusions you might see today. Also excluded things like theft or, well, that's all I'll talk about, the neglect of the insured to preserve their property. So if you were a homeowner and your home started burning, you were expected to go in and gather your belongings and bring them out on the street, which was unfortunate because thieves used to target thought burning buildings as a good place to pick up loot because people were carrying their things out of the burning building, and theft was not covered by your policy, so you were sort of caught between a rock and a hard place. If you gathered your things and brought them outside, you ran the risk of theft, but if you left them inside, you ran the risk of your insurance company not paying you. All sorts of other things were excluded. So if there was an explosion, lightning was not a covered peril, and collapse was a very big issue. So if you were a claims adjuster back in 1900, you spent your time figuring out whether the building burned and then collapsed, in which case a claim should be paid, or collapsed and then burned, so it was blown over by wind and then subsequently a fire started and it shouldn't be paid. And you were insuring just the home, so just the main dwelling, no other structures, tool sheds, outhouses, nothing like that was covered. Personal property, basically, if you didn't tell the insurance company about it and buy a property specifically for it, anything, or coverage specifically for it, wasn't covered. So all the contents of the house weren't covered. And avoidance provisions were pretty tough. So if you went on a business trip or on a vacation for 10 days or more, the policy was dead. So when I say fire insurance, I mean very literally, this was a policy that covered fire and nothing else. Now the problem for the industry, the existential crisis that I mentioned before, is that fire was in the process of being tamed. So picture yourself in this industry, you have 90% of your premiums coming from fire insurance, and fire is about to stop being a problem or stop being a major problem. So the last major urban conflagration, last major urban fire in the United States was in San Francisco in 1906. That was basically the last time that a large section of the city would burn down, which is a great thing for humanity. So better building codes, firefighting techniques, these are all good things, but if you're in the business of protecting financially people from these sorts of risks, it was a very threatening thing. So if you were bouncing your child on your knee in 1900 and you had a crystal ball and see that fire insurance was going to disappear, you couldn't possibly encourage them to go into this business. I mean, it would be suicide, right? Excuse me. Turned out that it wasn't. It was actually a very good business to go into. We saw a remarkable growth throughout the 20th century. So starting in 1900, again, industry premiums amounted to about 1% of GDP. By 1920, it was up to 1.6%. By 1940, and growth continued. So by the 1980s, we're at about 4% of GDP. So property casualty insurance in relation to the economy grew a lot more important in the United States over the 20th century, even though its major business basically imploded. So by the end of the 20th century, if you looked at what fire insurance, what it originally was named for in 1900, accounted for, it was a fraction of a percent, maybe a tenth of a percent of its total premium volume. Its business had fundamentally transformed. So if it wasn't fire insurance, it certainly wasn't, what were the main drivers of growth in the 20th century? So it wasn't about fire insurance, but new risks to wealth through technological innovation and legal innovation were really key drivers. The insurance had to move outside, the industry had to move outside of its comfort zone in property coverage and start insuring the home and other types of property against other types of perils other than fire. And the industry was also helped out by compulsory insurance. So the government in a number of areas started requiring households and businesses to buy property casualty insurance in various forms. So I'll talk about that in a second. So first, let's start with technological innovation. Fire was on the way out, but the auto was on the way in. In some ways, this was a key savior for the property casualty insurance industry. I was giving this presentation at a bit like it some time ago, and a gentleman in the front row stood up and said, "What do you mean Americans invented the auto? It wasn't the Americans, it was the Germans." And yes, he was right. It wasn't, it certainly was not invented by Americans, but mass production was a technique that was refined in the US, at least in the area of autos. And this really got online in the early part of the 20th century. With cars came all the mayhem that we know about on the roads, and this was something that the insurance industry was well positioned to start insuring. Okay, other types of innovation. Anyone know who this guy is? He looks familiar. Okay, right. So this gentleman's name is David Dow, and he was seated on a United Airlines flight, and he refused to give up his seat when the airline asked him to leave, and so they dragged him out. What do you? Yes. He's going to be, exactly. So the next question I was going to ask was, should we feel sorry for David Dow? Was he mistreated? I'm not sure. People feel differently about this. Maybe when you're asked to leave your seat in one of these situations, you should just get up and go. But he chose not to. He chose to sit there. They called the police and dragged him out. But as Emmer suggested, maybe we shouldn't feel so sorry for him in terms of what's eventually going to happen. So what he did was lawyer up. So he hired a lawyer the next day. The lawyer was on TV talking about how bad and awful United Airlines was, and the family was in tears, and so forth and so on. So there will be a big lawsuit, and I'm not in the business of prognostication or making predictions, but I suspect that United Airlines will pay him a hefty sum so that with the condition that he gets off social media and off the airwaves and stops complaining about how he was treated. Okay, so was he badly treated? And what is he entitled to? I don't know. But let me tell you a story about how things used to be and how bad some other people have been treated and how different their treatment was by the legal system in the United States, despite that bad treatment. So this is how different things were. Imagine you board a tour boat in New York City. So this was the general slogan in 1904. You go out for an excursion on the East River, the boat catches fire. The crew ignores the warnings of passengers that there's a fire on the boat. There are no lifeboats. The life preservers, and life preservers are required, have been sitting there for 13 years. So when people grab for the life preservers, they crumble. And the ones that don't crumble have actually been stuffed with iron pellets because the manufacturer actually used cheap materials or flotation materials and tried to increase the weight of the life preservers by putting iron pellets in the life preservers. I guess that increases the weight, but it obviously doesn't help too much with flotation. So the people who many of whom couldn't swim, as was typical at the time, drowned. And about 1,000 people lost their lives in that event, making it the biggest disaster in New York City history prior to the World Trade Center attacks in 2001. Another disaster, the Triangle Shirtwaist Factory fire you're a young female immigrant, you take a job at the Triangle Shirtwaist Factory, making shirtwaists. I'm not sure what shirtwaists are, but they were making them. Management is piling oily rags in a corner, and oily rags have a habit of combusting spontaneously sometimes. They did. So they started burning, and the young women ran for the exits, but the exits were blocked because management didn't like their employees taking breaks. Some of them found their ways to windows and jumped, others of them suffocated from the smoke. The ones that jumped didn't fare too well because it was on a high floor. I don't know, when you say these people were treated worse than David Dow, maybe, but they collected very little, if anything, in terms of compensation. So legal doctrines at the time favored defendants in these cases very much in the US. So there was a notion of assumption of risk. If you got on a boat, you understand boats are risky and that they might sink. You can't blame anyone for drowning. Contributory negligence. If you had anything to do with your plight, so threw an oily rag on the pile, or if one of your fellow workers, a fellow servant, did the same, you were also denied compensation. And in any case, the main asset in these cases that was the tour boat, and you could only sue the tour boat operator, and the factory equipment in Florida were the main assets of the Triangle Shirtwaist Company. So there was nothing to recover, even if you could succeed in the courts. Now, obviously, things have changed a lot, and in order to get there, we had to, the legal system went through some fundamental changes in its notions about what an accident was, what damages were, and who could be held liable for them. So just to give you a flavor of that, of how the times changed, here are a couple of professions that if you ever have a child who isn't interested in doing their studies, you can tell them, well, if you don't study, you'll have to work as a stone cutter or a rock crusher. Not that these are necessarily bad avocations, but they're harder ones than I think ones that most of us are accustomed to. Young was a stone cutter, and as you might imagine, while cutting stones is pretty easy in video games like Minecraft, it's not so easy in real life. His muscles atrophied, his nerves broke down, and he attempted to get some compensation for this. But the court determined that no accident had happened. Your body just wore down after years of work. This wasn't an accident. This wasn't something you could blame on a specific event. You couldn't collect any compensation. This was in 1922. Later in 1934, the court determined that, well, in the case of a rock crusher rather than a rock cutter, that inhalation of the dust from rock crushing and that grinding on the lungs over a long period of time did in fact constitute an injury that could be compensated. So, this was actually, that seems, the latter view seems like a standard one now, but it took some time to get there, and the change was rather gradual. Damages, what is damages? Imagine you go to a performance, an animal performance or a circus. You're seated in the front row, and one of the horses backs up and makes a large deposit on your lap. Have you been hurt in that? And of course the crowd laughs uproariously about what just happened to you. Is that something that you should be compensated for? Well, this case came up in my home state, or my current home state of Georgia, where a woman did go to the circus and had this happen, and she sued. Now, what I find interesting about this case is not that she was successful. Well, maybe it's a little surprising she was successful in 1928. You would think that would be a very good place to apply the risk doctrine, namely, if you go sit in the front row of a horse show, you might get a deposit or an unwanted. They did decide to give her some money. Now, that would probably be second nature today in the U.S. But what's interesting about it is how they found it necessary, and sort of the court agonized over whether an injury had happened or not, and ultimately concluded that, well, if something lands on you, that's a physical injury, so we'll give you some money. Now, you don't see that kind of hand-wringing anymore. So a good example being the famous McDonald's case, where a woman bought a cup of coffee from a McDonald's, spilled it on herself, and was awarded $2.7 million in non-economic damages for pain and suffering and this sort of thing. Not to say that it wasn't, it's nice to get burned by coffee, but this was done in a heartbeat. There was no hand-wringing over whether an actual injury occurred or what the person was entitled to. Also, can you see this also broadened considerably? Back in the day, if you bought a car that didn't work so well, you could sue the person who sold it to you, but not the person or the company that manufactured it. This changed with the famous case in 1916, and also previously been difficult to sue hospitals or churches or other charitable organizations, even if something bad happened. This also changed over time. So in 1916, here's an example of a court refusing to hear a medical malpractice case, whereas by the 1950s, the court overruled this precedent, argued that you could in fact sue a hospital even though it was doing good work. What else was going on? So liability became a big problem, and it became a fundamental thing that the industry started to deal with, and became its bread and butter ultimately, as I'll describe in a minute. It also did a lot of broadening of the coverage that it offered people with property insurance. So remember, in 1900, very narrow coverage, focused very specifically on fire and only protecting the dwelling. This changed over the early 1900s. So now lighting was covered, loss due to removal of property, this problem you had with thieves, that was no longer a problem. Great expansion of the coverage of the contents of the building, and as well as the structures other than the main structure. Avoidance provisions were also relaxed, and you can probably see where things are going. So eventually legal technology improved, additional perils used to be handled through a hodgepodge of separate policies. By the 1930s, these were wrapped into a supplemental contract that was sold alongside the fire contract. So this was introduced in 1930. And the rates doing things this way helped out a lot because you didn't have to sort of debate what the cause of loss was. The same company that sold you both contracts no longer had a claim adjuster having to come in trying to see if the building collapsed and then burned, or burned and then collapsed. So this was a much more efficient way of doing things. 1937, this is converted to an extended coverage endorsement, and eventually in the 1950s, we see a multi-peril policy that covers the home against all types of hazards, so theft, burglary, fire, windstorm, so hail, all sorts of hazards, except for flood and earthquake, which are still left out, and I'll return to those in a minute. Another good thing that happened for the industry was the government started requiring people to buy the product. So Massachusetts led the way in 1927, forcing auto drivers to carry liability insurance. And now in the current day, almost all states have some kind of compulsory insurance. Workers' compensation, another area, I'll return to this in a second. Businesses are required to cover their workers for workplace accidents. Banking regulation and mortgage finance. So banking regulations around mortgages basically force borrowers to buy hazard insurance to protect the bank from damages to the collateral. Catastrophe insurance was another area where the government started requiring through the Flood Insurance for Disaster Protection of Act, and also some state level initiatives started sort of encouraging, if not forcing, the separate purchase of flood insurance and earthquake insurance. Just a picture on workers' comp. In many cases, these initiatives were sort of government doing perceived policies that were supposed to help people. In the case of workers' compensation, it was actually a case of the employers joining forces with other interested parties because of the rising threat of lawsuits. And they preferred a system where they understood exactly what the coverage was going to be and what the costs were going to be if a worker got injured, rather than having to fight over every case in the courts. So the crisis was averted. 1900, fire insurance is on its way out as an important source of risk, or it's still out there, but not nearly as important as it was. Yet the industry grew from 1% to 4% of the economy on the strength of broadening its coverages and also engaging in liability coverage and covering automobiles in particular, but adapting to the times and the changing court system to cover liability of not only auto accidents but any kind of lawsuit. So growth indeed happened over the 20th century. Getting up to in the 3-4% range of GDP, I'd take it up to the eve of the financial crisis. But some would argue that the golden age is over, and that the 20th century was a great century for property and casualty insurance, but things are about to get a lot rougher. And there are in particular two trends that need to be paid attention to. So number one, risk seems to be disappearing in the liability and casualty space and could disappear a lot more. And number two, we seem to be reaching areas where the industry is really reluctant to go in terms of expanding coverage. Now, this has happened before. Back in the day of 1900, the industry was very comfortable covering just very narrow fire insurance. It found it had to go outside of its comfort zone to evolve and adapt. So an open question is whether they're going to be able to overcome this fear and address these areas of unmet need. So this is a hard graph to read, but this is a picture of disappearing risk. So these are auto fatalities per miles driven. I think from 1970 through 2010. This is workers' compensation lost time frequency, medical and professional liability claims frequency, commercial general liability, so slips and falls, fire structures, loss count. So all of these are indications of declining risk. So fewer auto accidents, less severe auto accidents, safer workplaces, safer fire, safer fire standards and firefighting techniques. And a lot of things are conspiring to make this happen. So in particular, there's been pushback in the legal area. A number of states have decided that lawsuits are simply too expensive, so they passed reforms of the legal system. No-fault auto insurance is one example, where a number of states have decided that when accidents happen, your insurance company will pay you, except in the most extreme circumstances, they were deaths or disfigurements are involved. You won't bother figuring out whose fault it was. You just pay, and the lawyers aren't involved. Other states have passed non-economic damage caps, limiting the amounts that could be recovered other than for sort of direct expenses associated with the injury. a number of states have passed reforms to their workers' compensation system to keep costs down, but it's not just changes in legal rules, it's actually getting safer. So safer cars, safer workplaces, as I mentioned before. So what's happening? Well, if you look, this is a picture of net incurred losses in liability lines between the late 1970s and just at the time of the financial crisis. And from the peak in the 80s, the ratio of these losses to gross domestic product has fallen by nearly 50%. If you take longer term view and look at the late 70s, it's a smaller fall, but maybe 30% or 20% or so. So all of these factors, these